So, welcome to the Monkey Stock Club. For those who are new at this channel, my name is Monkey B. I love to go out there and finding some nice stocks just for you. So all you have to do is just watching this video and decided if the following stock could be something for your portfolio. It doesn't get much easier than that. In return to that, please feel free to hit the subscribe button below and become part of the Monkey Stock Club family so you will never miss a video again. Please be aware that everything I say here is just my opinion, as I'm not a professional investment advisor. As you can see, I'm just a monkey, but nevertheless, I love to analyze stocks just for you. So let's stick around and discuss some numbers now. Talk about Canadian Solar. They ended up at around about 35 US dollar closing price or before hours. And I would like to share this stock due to the fact that from my point of view they are highly undervalued, and it could be within the next years a great opportunity for us to let's say get a profit growth of up to 400%. So to analyze the Canadian Solar share, I use the well-known high growth investing analysis with the 6 KPIs. For each KPI you can get up to 3 points. So overall, as a maximum for the high growth investing analysis, and share can get in total 18 points. So let's get started with the first KPI. We end up at 1.12, so we will get 3 points. Also in screenshot from Finance Yahoo, they put in the ratio of 1.23, so almost similar. And the enterprise value is a measure of a value of a company regardless of its financing. So if you divided the enterprise value of the 3.5 billion by the actual sales of 3.2 billion, you get 1.12. So you can also find all the figures like the market capitalization minus the cash plus the debit divided by the revenue in the internet, for example Yahoo Finance. And that's our first 3 points for the first ratio and the KPI. The second one is the gross margin trailing 12 months. So the gross margin is the percentage of the sales that remains in the company after reducing it by the direct production costs. So you take the sales minus the direct costs and divided it by the sales. We end up at around about 25%. Within the point of HGI score, we are far below 50%, so unfortunately no points. And the gross margin provides us a good indication of the profitability of a business model, and the higher the percentage, the more money a company has available for sales, marketing, research and development, new products, for example. So that could indicate that Canadian Solar already invests a lot of money into the new products and software, for example. And that is why from the high growth investing analysis perspective, they don't have such a lot of money to invest in other activities, as I mentioned before, like marketing, for example. Rule of 40 score, that's really a simple key figure to assessing the efficiency of a company growth and the quality of its business model. So the ratio is calculated as the sum of sales growth. They have not a big sales growth, more or less 0% from trailing 12 months, plus the free cash flow margin. That is around about 18. So you use the operative cash flow divided by the revenue, and you receive around about 90%, plus the sales growth, which is not high, or let's say it ends up at 0 roundabout. we have 90%, so far below 40, so 0 points. And the higher the value, the better the business model of a company is. So the value above 40 can be considered as attractive. So that could indicates that currently the efficiency of the company's growth is not so well, due to the fact that they missed the sales growth within 2019, and also compared to the last 12 months. So it's really interesting how they will proceed in terms of the sales growth. Yeah. So again, the sales growth as the fourth in the KPI number 4, 0.35, 0 points, as we are far below 20%. And yeah, sorry, I just lost my connection. I need some new batteries for my mouse pad. Just a second. So here we are. Sorry for that. I will change it after this video immediately. So yeah, a screenshot from 2016 to 2019. Quite a nice development in terms of revenue, and then we have they slumped in 2019. The earnings, quite a good development as well until 2018. Then they had a decrease in earnings. The next one, the debit ratio. So the debit ratio is calculated by dividing the sum of the current and non-current liabilities by equity, and a ratio less than 1 indicates a low debit, while a ratio greater than 2 indicates possible risk for debit for companies. So if we take the 2 billion US dollar debit last quarter divided by the equity last quarter of 1.5 billion, we end up at 1.5, so not such a nice figure, as we are above 1.5, we received 0 points. Last but not least, the PEG. That's really a nice indicator or KPI, and one of the most important key figure for the assessment of an already profitable growth stock. So it calculates the ratio of the price per earnings and the profit growth. So as Peter Lunch already mentioned, if we have if the PE is equal to the profit growth, we received a ratio of 1, and this indicates an undervaluation of a share, and could be a nice opportunity and a nice time to invest in a high growth stock. So we have around about 8.4 S&P TTM. So here you can see also the value from Yahoo Finance. It's slightly different to my value, but nevertheless, divided by the profit growth, we end up at a value below 1. And yeah, that's quite good. That indicates that we have 3 points. So here we have a mistake. Sorry for that. Nevertheless, here we end up with 3 points, so not 0. Sorry for that. I need to update the slide deck. But anyway, if we go to the next slide, we will see the total sum of 6 points. Or we should. Yeah, okay, we should see it. Okay, and yeah, as I mentioned before, November 19th will be a nice date. I really looking forward to that they will present again in positive EPS, and that could be quite a good development in terms of the profit growth. So here just in screenshot, just how Canadian is it, the Canadian Solar. They are looking quite undervalued, but not looking really Canadian due to the fact that they have extensive operations in China, and they also try to capitalize on the market with a Chinese IPO next year. And yeah, we end up at 6. That's yeah, not the best value, but nevertheless, from my point of view, still a nice indicator that Canadian Solar could be future high growth stock. And here a screenshot from the estimated EPS for 2021. So if we just compare the estimation for 2020, 2.8 compared to 3.3. So here on the left hand side, I use the Peter Lynch's value. So the EPS for 2021 multiplied by the profit growth, the estimated, if we compare, or if we use the ratio of both EPSs, we end up at 69 as a fair price. So around about 100% price increase. That could be quite a nice development for everyone who will invest it in Canadian Solar. And in addition to that, what I did was to look into the last EPSs from the last 5 years. So the EPS of 2017 was 1.7 compared to 4 as an estimated EPS for the. Oh no, I didn't use 4. It's also in another internet site where they estimated around about 4, but I use just the comparison between 1.7 and 3.3. So there we end up at around about 200, and divided by 4 we have around about 58% profit growth as an average for the last years, multiply by the expected EPS of 3.3, we would end up at a fair price at 200. That could be an estimation for the next 5 years. So from my point of view, a very nice opportunity to invest into Canadian Solar. From my point of view, they are still undervalued, and yeah, put it on your watch list. I will keep you updated on Canadian Solar, and I hope you enjoyed the video. I would really appreciate if you hit the subscribe button below, hit the push button as well to get always some alerts when I post a new video, and you will be always updated on our early stage. And yeah, hope to see you again, and have a nice day. Bye bye.